Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The ripple effect, from 2007 yields to micro-market shifts. This video presents a direct informational narration of the source document. Right now, we're looking at a massive ripple effect starting at the very top of the macroeconomic structure. The U.S. national debt has hit $40 trillion. Because of this, we're seeing global bond yields steadily march higher, and the 30-year U.S. Treasury yield just hit its highest level since 2007. This extreme macro pressure is heavily impacting risk assets across the board.
Here is our roadmap for how we'll track these cascading effects down to specific sectors. We'll start with Treasury yields, then look at tech divergences, semiconductor pressures, grid impacts, and finally, retail and space.
Section 1. Treasury yields and bonds.
The sheer scale of this is crucial to understand. With the U.S. debt sitting at $40 trillion, there are growing concerns about persistently high interest rates. When you factor in the massive borrowing costs required to fund ongoing AI investments, market borrowing costs are surging.
So how are quantitative funds reacting? We're looking specifically at commodity trading advisors, or CTAs. They are currently shorting global bonds at record-high extreme levels. Their positioning is so massive that a single basis point move in yields equals a $300 million profit or loss fluctuation for them. This intense hedging is glaringly obvious in the options market, specifically for the TLT, Treasury ETF. Looking at the 90-day window, there's a massive one-sided volatility smile. On the put side, we see high implied volatility as investors aggressively hedge against further bond drops. On the right side, however, demand for calls is virtually non-existent.
But this extreme one-sided positioning creates a severe short squeeze risk. If interest rates drop even slightly, it could force all those short sellers to rapidly cover their positions. That covering would crash yields and could potentially spark a massive rally across the stock market.
Section 2. Tech market divergences. Recently, the Nasdaq dropped 1.33% as funds rotated out of high-valuation technology. But capital wasn't fleeing, it was moving into defensive sectors. Based on the strategic maneuvers observed, Apple was treated as a defensive anchor, supporting the broader market during what is considered a normal bull market pullback.
Section 3. Semiconductor sector pressures.
In the semiconductor space, extreme volatility is leading to some highly specific institutional activity. Right around 11 a.m. Eastern on Monday, a massive $1.29 million bet was placed directly against the SMH Semiconductor ETF.
Breaking down the exact specs of that trade, we see 21,000 put contracts at a $630 strike price expiring on November 20th. This is a brand new, large-scale put trade that capitalizes on the sector's currently inflated options premiums. To see how this looks for individual stocks, we can look at Micron's technicals. The stock is battling right at the critical $1,000 level. It's caught between strong AI memory demand on one side and institutional fears of a Chinese capacity oversupply on the other. If it loses that $1,000 floor, the next major support level is down at $740.
Section 4. Power grid impacts and utilities. Higher interest rates are directly hurting the financing costs of capital-intensive utility stocks. But there's also a specific catalyst. The PJM Power Grid recently submitted a proposal to federal energy regulators. They want data centers to activate backup generators when grid capacity drops to danger levels, reducing their reliance on the public grid. This proposal immediately triggered algorithmic sell-offs in utility stocks like VST and CEG.
That cascading negative sentiment spread quickly after major institutions analyzed the grid filing. For instance, optical module stock, CHOR, suffered a severe 12.75% drop as the market digested these potential infrastructure limitations.
Section 5. Retail and space. Looking at retail resilience, Home Depot beat expectations with $47.86 billion in Q2 sales, driven largely by outdoor and heat wave-related purchases. Meanwhile, the space sector is securing major institutional backing. Rocket Lab recently secured eligibility for a $980 million U.S. Space Force contract ceiling, showing how the broader sector is moving in tandem with SpaceX.
Mapping out the upcoming market volatility catalysts, we have a clear timeline of massive share unlocks. 900 million SpaceX shares unlocked on August 6th, and another 320 million unlock on August 20th, with 7 more batches scheduled before year-end. This is all happening right alongside the Jackson Hole Symposium and NVIDIA's upcoming earnings.